One, and we're good to go.
Hello, everybody. I'm Stephony Garrett with the Home Sync team with eXp Realty. And today I'm bringing to you Kelly Dooley, who is going to be talking to us about the different types of loan types. This is going to be session 2 of a 3-part series. So take it away, Kelly.
All right, Stephanie, thank you so much. All right, so in our first video, it was, what does it look like when I want to get approved? The documents I need, what does that look like? Now you're approved. We just got to figure out what's the best loan type for you, the best structured loan, most cost-effective loan for you, given your income, your credit score, etc. So let's start out. Several loan types here. Number one, FHA, the most common first-time home buyer loan there is. And what an FHA loan does, or minimum down, is to say, is 3.5%. Okay, so you're like, well, what does that mean? Well, take the price of the house. Let's say you're approved to 200,000. So you take 200,000 times 3.5%, and I want to say that's 7,000 bucks. So that's the minimum down for an FHA loan. FHA loans, again, are the most common first-time home buyer loan. They're the most flexible when it comes to that debt to income ratio that we talked about in the previous video. Allows for a little bit more debt and a little lower credit score as well. So again, in the first video, we can go down to a 620 pretty easily. FHA tends to cater to that demographic, that 620 to 700 range. Okay, so FHA 3.5% down. Next is the conventional loan. Conventional loan, the most common conventional loan is 5% down. Okay, so you would take 200,000, multiply that by 5%. That's your minimum down for a conventional loan. Now there is an asterisk. We do have a 3% down conventional loan, but that is for a first-time home buyer or 3 years removed from a house, or owning a house, I should say. Okay, and your credit really needs to be a 750 or higher to make it cost effective for you. Okay, but for this video and the purposes, 5% down is the most common conventional loan, and typically conventional loan wants to make it cost effective, I should say 700 or higher on your FICO score. Okay, it's going to be more cost effective if you have a little bit higher credit score. Okay, so conventional loan. Next is VA loan. Those are for our veterans out there, and thank you for your service. You've earned this loan because you did serve in the military, current or retired. And a VA loan, again, is geared for those military personnel. And you all know this, if you're a military personnel, you have to have that DD 214. Okay, so if you want to buy a house, first thing we're going to ask for is your DD 214. We take care of it from there. We turn it into the VA, confirm your certificate of eligibility, and we go from there. Well, what's a VA loan besides military personnel? It's 0% down. Okay, so like FHA was 3.5% and conventional is 5% down. VA is 0% down. The buyer in this case is just responsible for the closing costs. Okay, so closing costs only. Another advantage of a VA loan: no mortgage insurance on a VA loan, and I will cover that a little bit later in a second on mortgage insurance. So no mortgage insurance on a VA loan, 0 down, only responsible for closing costs. And yes, we need that DD 214. Okay. Moving on down to USDA. A lot of you know what that is. It's really for your agricultural farm houses. And those are specifically, I guess, earmarked throughout the country. If you're interested in a USDA loan, we have a website that we go to make sure that house that you want to buy is eligible for a USDA loan. Okay. You have to really have extremely good credit. I would say the high 700, 750 or higher for a USDA loan. It is 0 down. Again, USDA loan, like a VA loan, 0 down, but you really need minimal debt as well. So we can do USDA loans. They're just not very common in the Houston area, but out there in the farm to market roads, yes, we can do it. Okay, so USDA loan, zero down, just responsible for closing costs. Now, those are the 4 most common loan types, or all loan types. Okay, guys, what I want to cover next, and pay attention to this, is DPA, which stands for down payment assistance loans. Okay, so in the first video we talked about how to get approved, the 620 credit score, the 2-year work history, and the money saved for the down payment and the closing costs, right? So what a DPA loan does, it will give you financial assistance, 2%, 3%, 4%, or 5% assistance. Okay, it's offered through the state, and we're an authorized lender to do this. And yes, they are DPA loans for FHA loans. There are DPA loans for conventional loans. Okay, depending on how we structured your loan, what's the best fit for you, we can go either way. But basically, the most common DPA loan financial assistance that we do is 4%. So for this particular conversation, a DPA loan will pretty much cover your down payment. Okay, remember when I said FHA loan 200,000 times 3.5% is $7,000. Obviously, it's going to cover that part for you, which just leaves the buyer to cover the closing costs. Okay, so closing costs, and I'll get into that in a second, roughly 10 to 12,000 bucks. Okay, so that's all you need. That helps a lot of people, because a lot of people out there that have the credit score and the work history, but they may not have the whole down payment and the closing costs. The one qualification that you need to know to qualify for DPA loan is you have to make less than 99 grand a year annually. That's household income. That's one person, 2 people together, etc. Now there is one that we can do. We can go up to 110,000. Okay, so make sure you mark that down. And so what happens when you're a DPA loan buyer, we work with the state because they're the ones that give you the money to buy this house. They set the interest rate. You're like, Kelly, well, what's the interest rate? What's the difference in a DPA loan and a non-DPA loan interest rate wise? On average, it's about 0.5%. Not a huge deal. So that's how they kind of make their money back. Kind of like that saying, there's no such thing as free money. Well, the state will charge a little bit higher interest rate. And after 3 years of successful payments, you get to keep that financial assistance when you sell the house one day. Okay, so most first-time buyers, and Stephanie could probably agree, are gonna stay in the house more than 3 years. On average, I'm guessing it's 5 to 7 years, maybe. Well, you get to keep that money. Okay, that's the most common DPA loan. Now there is one where it's a little bit lower interest rate, but you have to pay the proceeds back when you sell your house one day. Okay, so I typically save those for people that are going to stay in that house maybe 10 years or more, or maybe this is their last move. They may not move again. I typically reserve that DPA loan for those types of buyers. So remember, DPA loans, down payment assistance loans, you need around 10 to 12,000, and we can get you in the house as long as you make 99,000 or less, or 110 in certain areas. Okay. Now you heard me mention the term mortgage insurance. I know a lot of people kind of know about that. The only way to get rid of mortgage insurance, it's built into your mortgage payment, by the way. Okay, so if your mortgage payment's $1,500 a month, it's already built in that. We have zero control over the mortgage insurance. It's based on your credit score, your DTI, the type of loan, how much you put down. There's 6 servicers across the country, and I hit a button, I picked the cheapest one. Okay, so the only way to get rid of mortgage insurance in your mortgage payment is to put 20% down or more. Okay, anything less, you're gonna have mortgage insurance. And that's what I do in the when I'm trying to figure out the structure, the most cost-effective loan for you. There are cases, if your credit is good enough, especially and this is on a conventional loan, If you put 15% down, I can see what your mortgage insurance is gonna be. It's only gonna be 15, 20 bucks, 25 bucks, and it saves you 5%. And it's gonna go away eventually in the year. I'm gonna recommend you go to 15% down route, okay? So that's a huge difference, 15% down versus 20% down, only to save 20 bucks a month. So, and when I mean it'll go away, so mortgage insurance does go away on a conventional loan, okay? When your house hits 20% equity or more. So if you put 5% down, 10% down, 15% down on a conventional loan, it'll go away eventually, okay? It'll drop off. That's the difference between FHA and conventional. FHA, your mortgage insurance is gonna stay on there forever until you sell the house, A, or B, refi into a conventional loan, which happens all the time. A lot of people get that FHA loan going because it's most cost effective. After a couple of years, they really like the house and want to stay in it, and the rates go down, we'll refi them into a conventional loan, and boom, it might already be at 20% equity and won't even be on there, or you're getting close. Okay, so mortgage insurance, get rid of it at 20% down or more. Now, closing costs, you heard me mention that term. What are closing costs? I get that question all the time. Closing costs are the appraisal, which is about 600 bucks, okay? 2, it's the title company and what they charge, their fees. Oh, and they're all about the same. I can't really say what, it's 2,500 maybe, something like that, 2,500 to 3,000 is the title company fees. Then it's the 1 year of home insurance. So when you buy a house, you actually pay for 1 year in advance of home insurance, okay? So the average is about 1,800 annually, 150 a month. That's, so you're actually gonna pay 1 year advance when you close on the house. So that's closing costs as well. Then they'll collect a couple months of for escrows, if you have an escrow account, 3 months of insurance, a couple months of taxes. So the starting of your escrow account is closing costs, and the lender, myself, our fees. So you bought all that together, those are closing costs, and again, they average about 10 to 15,000. It just depends where you buy your house, what the taxes are, the insurance, etc. So those are closing costs, and I mention that because Stephany, an agent like Stephany, or realtors out there, there's another thing called seller concessions. Okay, so when you buy a house, when it's listed at 200,000, let's say, it doesn't necessarily mean you have to pay 200,000. Okay, it's negotiable, like buying a car, right? Well, what I have recommended to my buyers, and Stephany does this all the time. Let's say you're approved at 200,000. Okay, we figured out a conventional loan is your best bet, 200,000. You go out with Stephany, she's got your approval letter, because you cannot make an offer, guys, without an approval letter. Actually, we're gonna get in that in the final episode of what the house buying process actually looks like. So for this video, Stephany knows you're approved at 200,000. You find something at 190, let's say. Okay. What we recommend, if you want to get what's called seller concessions, is this. Seller concessions is basically the seller agreeing to give you, I guess, money or financial assistance to cover some of those closing costs. Okay, it'll come out of their proceeds. They're not necessarily writing a check to cover it for you. It's coming out of their proceeds. If the seller is desperate enough or wants to get out of the house, etc., you caught them at the right time, you made a good offer, they'll give you seller concessions. They can, okay, they can. It's negotiable items. So in this case, you find a house for 190 because you're approved at 200,000. Stephany might recommend, look, if you need some help or you want some seller concessions, let's give a full price offer at 190,000. And in our offer, let's ask for 10 grand. Now, here's the deal. On an FHA loan, the max seller concessions, if you do 3.5%, is 6% on the purchase price. Okay, say 6% times 190, That's the max you can get in seller contributions. On a conventional loan, it's 3%. Okay, if you do the minimum 5% of conventional loan. Now, if you do 10% down on an FHA loan, even though yes, 3.5 is the minimum, you can get up to 6% financial assistance. Okay, I know it's a lot of numbers there. That's Stephanie and I's job to kind of hold your hand through that. So again, you make a 190 offer and it's listed at 190, and Stephanie said, okay, buyer or seller, I want 10 grand in seller contributions, and they might agree to it. That's $10,000 off that 12,000 in closing costs. So instead of paying 12, now you're paying $2,000. Okay, on a DPA loan, remember when I said you're only responsible for the closing costs on a down payment assistance loan? I had 2 closings last month where the seller gave 8,000 and 7,000. Okay, and it came off of those seller concessions. The state covered the down payment. The buyer only had to come up with about 4,000 in one case and 5,000 bucks in the other case, because the seller gave seller contributions, or seller concessions is another term. Okay, so kind of remember that seller concessions, and if you have questions after this video, call Stephanie, call myself, we can go over it again on the phone one-on-one. But so video 1, what's it take to get approved for a home loan? We told you about that. Video 2 right now, I got approved. What's the best loan type? It depends, like as you heard, credit score, how much do you have to put down? Do you have the whole thing? You know, and that's my job to figure that out. Sometimes you have enough options. You have an FHA or a conventional loan. So you're approved. Then that's going to be video 3, guys. The next video is, okay, I'm approved. I know how much I'm good to go for. Stephanie knows how much house to show me. What's that look like? Let's go find a house. We're going to talk about, you know, the offer, the negotiating period, the inspection, all that good stuff, how long it takes. So please, please, please stay tuned for video 3. You don't want to miss it. We're going to kind of cap it all off and tell you how it goes. So are we good, Stephanie?
We are absolutely good. That was great information, and I appreciate you so much for sharing with us the differences between them all, because this is a question that I get asked when I'm working with a buyer, and I always redirect them to the lender and tell them, I do the contract side, they do the finance side. If you have questions about the finances, it's always best to speak to your lender.
That's right. Well said, Stephanie. We'll stay tuned for video 3, and we'll catch you on that side.
Thank you so much.
Thanks, everybody.